Hey everyone, happy Monday. Today on the Final Bar, we will set the stage for this week by focusing on three key areas of market analysis. Top-down macro strategy, thinking about the S&P closing to the negative today. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to this Monday edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets. Monday is always an interesting day because we can set the stage for the week, focus on what happened today, think about the days to come, and focus on the key areas of the market where we want to maybe key in on some of the emerging trends. So far, the week starting with a whimper, right? The S&P, the Dow, the NASDAQ all finishing, going out of the gates, ripping to the upside, following off on Friday's gains. The Dow went below the zero line earlier this afternoon. The S&P just in the last hour closing just below Friday's close. The NASDAQ managing to hold up its previous gains because technology, the number one sector. But overall, what started out as a fairly strong follow-through day, all of a sudden becoming more of a not-so-much day. We'll look at a lot of the individual stocks and sectors that comprise the markets as well, see what sort of lessons we can draw from those. Great guests this week and elsewhere on StockCharts TV, but I want to tell you about some of the upcoming guests we have on this show. Coming up tomorrow on Tuesday the 10th, we have Mish Schneider of Market Gauge. Mish is fantastic. She's actually going to be part of our Market Outlook special coming up later this week, and we'll get a quick preview on her take on the markets. Wednesday should be a lot of fun. That's Jeff Hirsch. Jeff is the editor of the Stock Traders Almanac, expert in seasonality, the presidential cycle, really interested to get his take on the overall expectations for the year. We're going to have a little longer interview with him on Wednesday. On Thursday, the 12th, we have Tony Dwyer, the chief strategist at Canaccord Genuity in New York. Then on Friday, not on this show, but elsewhere on StockCharts TV, I think running at 9 a.m. on Friday, is our Charting Forward 2023 Market Outlook. I'll be sitting down with Tom Boley of Earnings Beats, Mish Schneider of Market Gauge, Greg Schnell of Osprey Strategic. We will be having a roundtable discussion about what to look for, what to expect, some projections for the year, and some of the themes that are top of mind for them. Should be a really good way to get things started this year and start to plan yourself out for success through the course of this year. Continuing our show today with our market recap, let's talk three pieces of the market analysis on a Monday. We'll start big picture, talk about the macro themes, then go through sectors. After the break, we'll come back and talk about individual stocks. But let's look at what happened to the markets today. The S&P actually finishing in the negative. That's not what I was prepared to say. Lunchtime Eastern time as I'm getting things set up here at the StockCharts office. Around 9 a.m. Pacific, and I'm seeing this market just continue to push higher. All of a sudden, it felt like a great follow-through day. And obviously, this is when earnings starts, right? Earnings season really starts aggressively on Friday, but they're sort of dribbling in here over the course of the week. Starting Friday, we're going to get a lot of earnings inputs every trading day for the most part. However, by the end of the day, look at how things sort of turned just before lunch and the afternoon, sort of limping into the end. So while Friday closed just below 3,900 and we powered right above it, we closed right below it. So still 3,900 remaining a level of resistance, I would argue, after today's session. The NASDAQ managing to finish a little bit stronger, although again, weak in the second half of the day, just like the Dow and most of the major averages. The technology sector was the number one, up over 1%. That's what allowed the NASDAQ to do well. Mid caps and small caps, both flat for the day, kind of very similar to what we saw with the S&P. And the VIX pushing to the upside, which could be a really interesting data point. What happened this morning is the VIX gapped higher to just below 22, sort of came off as stocks were rallying in the morning. In the afternoon session, you see how volatility expanded as stocks started to roll over. And all of a sudden, the VIX is well above 20, almost to 22 at the close. That chart of the VIX we highlighted on Friday, that was one of our 3 and 3 charts. I'm convinced that that's going to be one of the key charts to pay attention to. Certainly was helpful in 2022, but I think as 2023 begins, if you're in that bull market thesis thinking that this is the beginning of a broad recovery and we're just waiting to see all these stocks follow through, I would be looking for the VIX to get below 20 and kind of stay there. We're not seeing it on a day like today. We're seeing the opposite. Bonds having a pretty decent day with the TLT up 0.5%. Interest rates coming off. We've talked about the interest rate environment. $ TNX, I think, is one of the most important charts, certainly last year, to follow because the strength in the higher rate environment, the weakness in the bond markets, as evidenced by the $ TNX and $ TYX being so elevated. That's the 10-year and the 30-year Treasury yield. That basically provides the context around leadership in the markets. Growth stocks tend to underperform when rates are high. Growth stocks tend to outperform when rates are lowering. So rates coming down on Friday in a pretty big way, continuing to come down on Monday, allows growth sectors like technology to have a pretty decent day, push to the upside. Maybe the most important thing is the fact that the dollar index has continued to come lower. I think that could be an important chart to watch for sure as well. Looking at the commodity space, commodities as a whole doing okay. Crude oil having a pretty decent day. Gold and silver kind of mixed. We've talked about the GLD. We highlighted that a number of times in the last couple of weeks. Really strong chart coming out of the lows in the fourth quarter. And overall, managing to eke out a bit of a gain on the GLD, but nothing dramatic just yet. Cryptocurrencies, for the most part, all in the green today, although they pulled back a little bit with the equities here in the afternoon, but Bitcoin remaining above 17,000. Ether managed to get above 1,300 over the weekend into this morning session and remaining above there at this point. Let's look at a daily chart of the S&P here just to continue our macro analysis. Last week did my monthly chart review for my market misbehavior premium members. And one of the big takeaways was just taking a step back from sort of the day-to-day movements in the major averages and focusing on the long-term trends on charts like the S&P 500. I love to boil things down to simple, what I call lines in the sand, right? A line in the sand, a level, a signal, a pattern that you're waiting for. And what that allows you to do is not have to stare at the chart of the S&P every minute to minute. You can just have some levels jotted down, have them saved as a price alert on StockCharts, or put them in an Excel spreadsheet, and then just keep tracking to see if those levels are violated. For me, I think the S&P settled into a pretty self-explanatory range. On the downside, we have 3,800. That was support starting last May. We've traded around those levels for quite some time. But in the second half of December, that became the support, right? We kept trading there. We once or twice closed just below it, but not for anything further than that. Kept bouncing off there. So clearly buyers are coming in at S&P 3,800, and that's where that's the level at which people are pretty excited about owning, reinitiating positions here. Friday, we bounced off of the level. Today was a great opportunity for bulls to be 100% vindicated with the S&P following through to the upside, what I call a follow-through day. So not only did you have the breakout, you had the follow-through. This is not a follow-through day. This is what we'd call a shooting star candle. And I'll show you what that means if we get to this chart. Here we go. So if you look at this chart, this is just looking at a candle chart of the last month or so. And if you look, you can see here's Friday session, this range around 3,800 to 3,870. The rally on Friday, again, a decent up day, trading up to the 50-day moving average, not closing above it, but getting close. Today, we traded right through it, but we closed back below it. And that candle where the open and close are near the lows and you have a big upper shadow and limited lower shadow is called a shooting star candle. And it's bearish. That suggests the short-term sentiment is more negative. It happened right at the 50-day moving average. So that's 1, 2, 3 times we've tried to get above the 50-day, and this last one getting a negative candle pattern. So that tells me to expect some weakness in the next 1 to 3 bars using the daily chart. If we would go lower, as that candle chart would suggest, 3,800, again, I can't stress enough, that's a key important level. On the upside, this trend line connecting the 2022 highs, I think that's as good as any as a measure of the overall trend. That has defined visually this downtrend that started at the beginning of 2022. Until that line's broken, the trend, again, by definition, is still going lower. Just elsewhere here to wrap up our market recap segment. Want to look at intermarket analysis. And I just want to hit on one other chart, which is this one, the chart of gold. We've talked about gold and its emerging signs of strength. And I think one of the things to highlight when a chart rotates so clearly from a distribution phase to an accumulation phase is when things would change. At this point, I'm still seeing higher highs. I'm still seeing higher lows. Pull back a little bit going into the close, but overall the momentum strong with the RSI above 50, the relative strength improving as gold has been outperforming stocks. At this point, I'd be inclined to give the benefit of the doubt on charts that are working for them to continue to work. But we'll have to see, make sure it holds above any sort of pullback level if we see a reversion back to the downside through the course of this week. Our second segment today is called Sector Setups. What we like to do now that we've set the stage with the big picture, sort of this consolidative pattern, lack of follow through today for stocks. Let's look at some of the sectors that comprise those S&P sectors. We start with the RRG, the relative rotation graph. I was chatting earlier today with Julius DeKempener, who created this visualization years ago. And it's been so much fun getting to know Julius over the years. And years ago, one of the things we asked him to do when I was at Fidelity was send us the RRG, and he would update it every week. And we would take those images and put them in motion and actually look at, flip through the pages and actually see the sectors rotating. And what's really cool is you have that feature now built into StockCharts because we've upgraded our use of the RRG and visualizations such as this. So now you actually can, take a look at how the sectors rotate and actually look over time and see since the October low, what's happened to these 11 S&P sectors. And when you do that using the weekly data, and again, we're starting at the October low, you can see that at the beginning, energy, healthcare, financials, really the strongest sectors. As we went on, you can see energy now still strong, but heading in the wrong direction. It's actually heading southwest, what I call the direction of deterioration. What is improving and taking up that slack in the strongest positions? I would argue it's two sectors, materials and industrials. And we've highlighted some of those names. Obviously, we talked about gold, but other areas of the materials sector have certainly been showing some renewed strength. In industrials, you have things like Boeing, Raytheon with these really nice moves off of the lows and emerging strength. Boeing is up by 50, 60s plus percent. Off of the lows. So really having an incredible run, but a lot of the stocks have been beaten down so much that there's a lot of room to go higher. But what's really interesting to me looking at the weekly RRG this week is look at the defensive stuff in the far left side here, particularly in the improving quadrant, utilities and real estate. We'll focus in on like the utilities sector. So I'm highlighting that and look as we rewind to the October low. You can see utilities in the weakening quadrant heading southwest, direction of deterioration, underperforming right there with consumer discretionary. Look at how it completely reverts. So while the XLY heading southwest because Amazon, Tesla having a decent bounce, but still pretty, close to 52-week lows. Utilities, on the other hand, really accelerating to the upside. You see that with real estate as well, kind of heading in this northeasterly direction. If I'm bullish, I would be concerned on the fact that you're seeing defensive stuff like utilities and real estate really starting to make up some ground on a relative basis. You're seeing some of the cyclical leadership roll lower and those defensive sectors rotate higher. That might be an important theme to watch here going through earnings season, because that's where a lot of things will have catalysts and they can move very, very quickly. Let's finish off our discussion of sectors looking at the 11 S&P sectors using our candle glance function. So here we have the 11 S&P sectors, then the S&P in the bottom right. When I'm looking at this sort of visualization, my goal is to focus on what looks good and what looks bad, what looks similar and what looks different. That's sort of the basic approach I'm doing here. So overall, what looks good, and we would define good very loosely by a sector above two upward sloping moving averages. That is the definition of an uptrend by using the 50 and the 200-day moving average. That's a good starting point for general sense of what sectors are kind of getting it done. What's interesting is there are not many left that are kind of in that configuration. As a matter of fact, I'd probably say the only ones would be this one, Staples, which chopping around here recently, but still above an ascending 50-day moving average. And the industrial sector here, again, bouncing off of the 50-day moving average and rotating to the upside. Things that had been looking but are kind of choppy, like utilities above both the moving averages, but they're kind of crisscross. So you have the 50 below the 200-day. That's not as ideal. Healthcare had been looking very strong, but just here recently breaking below the 50-day moving average in the last couple sessions, pushing to the downside again today. So all of a sudden starting to look less ideal than it was maybe a couple weeks ago when we're making new highs in mid-December. A lot of the healthcare stocks, when we get back from the break, we'll look at a couple of those, maybe Baxter, Merck. These are ones that are having a bit of a challenge here recently. And then you have a bunch of others that are kind of in a no man's land of uncertainty, right? Things like materials and financials overall could be strong, but still kind of the 200-day moving average, not quite rotating higher yet. So this is the chart of the XLF. And again, if you look from mid-August to early January, outperforming in a pretty good way. If you look at certain stocks in the financial sector, certainly the non-US financials, things like European banks, Japanese banks, these charts actually look incredibly strong, and to even a more extreme extent, maybe overextended, right? They've had an incredible run to the upside, and arguably would have challenge actually following through much further without some sort of significant pullback or a break pattern. But with the rest of financials, we've seen some strength as well. But now all of a sudden, the question is, do we propel through this level of resistance? The XLF now testing the high from mid-late November. This is where we stalled out here around $36. You can see we rotated back down, but now once again testing those levels. Financials is an interesting sector because you start to have earnings this Friday. We've got, let's say, JP Morgan, a number of others. What else? Citigroup, Wells Fargo, BlackRock, Bank of America. These are all reporting on Friday before the open. So we're going to start to get a lot of catalysts very quickly for those stocks. And I would say by this weekend, we could have a really interesting, maybe different picture of the upside potential in some of these banks that have had some pretty impressive charts so far, but haven't really followed through quite yet. Just to finish off before the break here, I'll bring up JP Morgan just to sort of segue into where we'll be after the break. You know, the chart of JPM on the surface, is this a constructive or a destructive chart, right? Positive, negative, thumbs up or thumbs down? I would have to say thumbs up, and I will tell you what conditions caused me to say that. Number one, it's above two upward sloping moving averages. That's always a good place to start. It's above the 50-day. The 50 is above the 200-day. They're both sloping upwards, although the 200-day just barely, but it technically is. You have the relative strength improving over the last 3 to 6 months. It's done better than the average stock out there and made a new swing high on Friday's close. Down a bit today, but overall, that's a chart that I would probably give the benefit of the doubt to the upside. We're going to take a quick break. We'll start with the financial sector and then go through some of the other names reporting earnings this week and which charts you should be familiar with. We'll see you back here in a minute. Hey guys, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is so great to be with you here in the beginning of 2023. Great to be back in the swing of things doing the Final Bar. We have a lot of really cool things planned for the show, and I'm really excited about the guests we have this week. Mish and Tony and Jeff Hirsch are just three fantastic guests. So starting the year off strong guest-wise, and we got a lot of really good people to bring through as well. A couple quick announcements before we continue on today's show. First off, we'll do a mailbag segment on Tuesday and another one at the end of the week on Friday's show. And we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We have so much great programming around year-end and a whole set of really cool stuff planned for you here at the beginning of the year. Larry Williams just dropped his market outlook last week. We have our StockCharts market outlook coming up at the end of this week. We have a lot of our StockCharts contributors having their first shows of the year, giving you a sense of where they're at and what sort of levels and patterns they're looking for. All of that content is available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Before the break, we were talking about the financial sector. One of the stronger sectors, certainly in October, November, pulling back a little bit in some of those names, particularly the big banks like JP Morgan and Citigroup. We're going to start again here with the chart of JP Morgan. As I mentioned before the break, kind of a compelling setup here. And I know this is one of the names that I was sharing with my premium members of Market Misbehavior on Saturday's weekly flight plan. We talked about JPM and some of the other financial stocks, some of the mid-cap names that look kind of compelling. And I like charts that are having strength, then pulling back to the 50-day moving average and rotating higher. Look how the RSI remained above 40. It's kind of a nice classic bullish setup. Now, there's no guarantee this thing can't drop like a rock tomorrow, or they report earnings on Friday and that could be it. But overall, I think technically this is a benefit of the doubt to the upside, makes a ton of sense. Let's look at a couple other stocks in there. Bank of America is another one that's reporting on Friday as well. A little less attractive, right? So you can see they're not all the same chart. With BAC, you get a bit of a different look here. BAC actually reminds me of a chart of the S&P 500 in that if you take this little inspect tool, look at where we're at right now and look back to May. This is the same level, right? We reached this level first time from the upside around 33 and 34 in May. From there, we've basically rotated all around there. And I bet a median price for this period is right around 33 to 34, which is kind of where we're at today. So from May to early January, we've gone nowhere directionally as a stock. There was this big distribution phase. Now we're in a consolidation phase. You have clear support down here, right? Just below 30, 29.30. You have clear resistance to the upside, really 36 to 38 is where I would sort of play that in here, going back to the bounce off of the May low. So we're kind of in no man's land. We're kind of in the middle. Now, what's interesting about a chart that's in the middle of a consolidation going into earnings, a lot of times that's when you get that big move because we hear something in the earnings call. We get a sense that the picture may be rosier or darker than has been priced in so far. It's all about forward-looking expectations. The challenge with a lot of names, particularly consumer names and others, is pricing in things like inflationary pressures, how that really impacted their business, and looking forward, how that is expected to impact the company's businesses through the course of this year and even into next year. For banks, what a higher interest rate environment and the inverted yield curve may mean for them. And commodity-oriented sectors like energy and industrials, what that means for their businesses. So we certainly could have a catalyst for these charts to break out of these ranges. It's all about where we hold, and I certainly on BAC would be eyeing that December low. As long as that holds, this is still a chart kind of constructive off of the lows, but that doesn't hold, all of a sudden that could be a bit of a concern. Let's continue on here. Next one I would look at would be Lululemon. So Lulu, that's not it. Here we go. So Lulu down pretty big today, down over 9%. And what you have is you have a number of companies sort of changing guidance here, all sort of news driven, and Lulu kind of gapping to the downside about 9%. You can compare that to ANF, same group, same sector, essentially having a 9% move to the upside, gapping higher because of stronger guidance. So you're certainly going to get some of this as well. And again, this is one of the risks of looking at individual stocks and having exposure to individual names in your portfolio is you have what's called company risk, which is company-specific risk, less exposure to the sector, less exposure to macro drivers, what we call beta, but more exposure to the individual company and the nuances around their business. So this is a scenario where two stocks in the same group, you have ANF gapping higher by 9%. You have Lululemon gapping lower by 9% as well. So let's look at each of these charts here very quickly. Lululemon is a concern for me because it's breaking to a new swing low. And that's why I often talk about stocks making new swing highs, which is why Lulu started to look kind of interesting here in late November because it's getting above the September high, putting in a higher low, looking pretty good. But then we have the gap lower, and we've never regained the lower end of that gap around 350. I would need to see the stock get above 350 to sort of reverse that negative gap, at least for now. And certainly now that we're continuing to gap lower, I think this is a chart in a downtrend until proven otherwise. Now, at this point, you still have a higher low from last October, but overall, the direction of this gap really is telling me that the path of least resistance appears to be down. Now, compare that with Abercrombie and Fitch. Now, while the move higher was impressive and an 8+% move is certainly welcome in at a time when the markets have been difficult, but remember that's just the latest bar among other bars. I would say the picture has been improving since early September, right? We sort of stabilized here in September and October. Now we've made higher lows in November. We gapped up in November, made another higher low around 2050. This is a chart making new swing highs and new swing lows. That is a Charles Dow thumbs up Dow theory uptrend. Look how the momentum on these swing lows has remained above the 40 level for the RSI. I think that's a much more constructive chart. So even within consumer discretionary, you have two similar names, but with very different charts. And as always, I would focus on the stronger charts where if you're looking for opportunities to be in. I do want to point out some of the semiconductors certainly having a pretty good day as well. You have NVIDIA on semiconductors. Empower was in the top list. AMD all in the top 10 list of S&P stocks at some point today. I didn't check going into the close if they'd remained up there, but NVIDIA is sort of an interesting chart as well. potentially setting up as an inverted head and shoulders pattern. And what I mean by that, if you're not familiar with what I just said, is this pattern right here. If you're looking at a chart and you see a low, and then you're surrounded by a higher right and a higher left. So this is the inverted head and shoulders. Think of someone hanging upside down. This is their head, their two shoulders. Now, here's the key. It is not a valid head and shoulders pattern yet. And I will tell you the point of this pattern, and this is really, really important, is breaking the neckline. So the rule, technical analysis 101, pattern 101, is you take the head and the two shoulders and you find the swing highs between those. So the highest point. So there's the high there. There's a higher. You need to draw a trend line connecting those two. And until the price gets above that trend line, what's called breaking the neckline, this is not a confirmed head and shoulders bottom. I see a lot of people doing wishful thinking technical analysis, which is saying, yep, it's a head and shoulders bottom. You got to buy it. And not true, according to the Edwards and McGee kind of experts in pattern recognition. You need to wait for that to be confirmed with a break above the neckline, which means you're looking for NVIDIA to get above 185 to confirm that pattern. Now, that could definitely happen. It just means it hasn't happened yet. If you would revert lower, I'd be looking right at that 140 level. That's the low from mid-December, late December. That might be an important level to watch for sure. Others in that sector and in that group obviously doing well. I'll finish on a high note as we wrap up this segment. LVS, there are charts that are looking good. And what's interesting about the equity markets, particularly now, but most of the time, is regardless of what the macro environment is doing, there's some stock somewhere that's pretty constructive. I love this setup in LVS. If you look at the resistance in February, you can see we got just above there in December, stabilized here for a couple of weeks, now breaking above there going into the new year. I like charts that test resistance and follow through. And I think today's up move is following through that positive sentiment we had through the course of last week. I think LVS and others in that gambling space, like Win and others, setting up pretty well. We need to wrap the show and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1, the New York Composite Index. I don't look at this index as often on the show. This is part of my morning coffee routine. I go through some of the different equity benchmarks in the course of trying to make sense of what's happening as an investor. I noticed a very similar pattern to what we talked about with NVIDIA. This isn't an ideal head and shoulders bottom by any means, but this is certainly a basing pattern. What I mean is there's a very clear resistance level. On the New York Composite, look between 15,800 and 16K. You can see this green shaded area sort of comprises the high in June, the high in August, the high in November and December. We're getting up toward that level, and you get above 16,000 on this index. All of a sudden, it would suggest, I would argue, a move to all-time highs to retest those highs. We have to get above that level yet. Today, sort of getting that shooting star candle we found in a lot of places. The momentum, the RSI not getting above 60, so not as ideal of a chart just yet. But I'd be looking to see if we can get above there. If you're bullish on stocks in the first part of this year, I'd be looking for this chart to get higher than it is. And there's the level I would be watching. Chart number 2 is Bitcoin. Now, I often have been asked in interviews about Bitcoin, what would it take for you to be bullish on cryptocurrencies? And my first sort of sarcastic answer is they'd have to stop going down. And I would say on the chart of Bitcoin, we may be seeing that develop, but it's still a little too early to say. And what I'll tell you is, Bitcoin bottomed out. You can see these levels around 15,550, 15,500. You can see these lows here in November. We pulled back, but didn't test those lows in December. We only got down to 16,350. From there, we're starting to rotate higher. So again, not going down is not bearish, but it's not necessarily bullish. Starting to rotate higher, starting to show signs of improvement is what I'd be encouraging. I would need to see this follow through above 18,000 and the RSI get above 60 and show stronger momentum. We're right at the point where previous rallies have stalled out. Does Bitcoin have enough to change the picture of this chart going forward? Finally, the ARK Innovation Fund. I had some conversations at the end of last week, and I was looking at some charts over the weekend, read some articles about Kathy Wood thinking about the ARK Innovation Fund with, again, renewed bullish sentiment from the good folks at ARK thinking about these disruptive technologies that have an opportunity to disrupt, and that absolutely may be right. I will say you from a technical perspective, charts like this don't look attractive until they do, until the price tells you this is setting up a constructive pattern. The momentum is what's most important to me, remaining in that bearish phase. Rally and get the RSI above 60, then we will start talking about the upside potential in ARK. Folks, that's a wrap for the show. Thanks for joining us every weekday after the close. I'm Dave Keller with StockCharts. We will see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.